So what we're going to do is going to use the handout here, or if you have it, you can have it on your, if you have a printed copy, or if you have it in your ebook. But anyway, we're going to go ahead and do these journal entries. We're going to go through this sheet here and kind of figure out where they go. Okay, so let's go to the first one here. Jay Crowley transferred cash from a personal bank account to be used for the business in exchange for common stock. So transferred cash from the personal bank account into the business. And gave up common stock. This was actually kind of a difficult one. Looking up here at our accounts, what accounts do you think the business is going to use?
Accounts payable.
Not accounts payable. He's already paid it.
Cash.
Cash.
Yep. Hold on a second. Cash is certainly one of them.
Common stock.
Yep. Okay, so the business is, you transfer cash into the business. So all these journal entries are going to be from the business's point of view. So from the business point of view, did cash go up or down?
Down.
Actually, for the business, it went up. Now, what's this guy's name? For Jay Crowley, his bank account went down, but the business itself has this cash now to work with. So it's going to be an increase for the business. And now the business, does it have more owners or less?
Increase.
Yep. More. It has one owner, which is more than it had before. It had 0 before. So, okay, this is October 1st. 19Y6. I hate when they do that. They do that so they can, I don't have to change the dates, but we'll say this is 16. Okay, so we have cash and common stock. Let's take cash. Cash is increasing. Now at the end of this thing, down here, we have cash. It's an asset. And it's going to increase with a, you come through. Ray, you can come through. Okay. So it's going to increase with a debit. While we're here, we may as well go to the equity section. And common stock, equity account. So common stock will be the credit and cash will be the debit. Nice cash. Cash and asset going up. And how much can you put in? 40,000. Common stock is an equity account. That's not right. And it's also going up. So the business has 40,000. Oops, 40,000 more. And The owner has $40,000 of investment in the business in the common stock. Okay, let's go to B. Paid rent on office and equipment for the month, $4,800. Let's look at these accounts up here. So paid rent on office and equipment for the month. Sorry, what was that?
Rent expense?
Rent expense and what else? Says we paid the rent, so would we probably
Accounts payable.
close? Because it says we paid it, we probably paid it with
Cash.
cash. But if we didn't pay it, it would have been accounts payable. But that's not a bad. A lot of times, expenses are payables. Okay, so this is. I think these are all on the same date. I think they said. Okay, so we have, oops. Okay, rent expenses are always increasing. Unless there's some kind of an error. What's happening to our cash? Is it going up or down?
Down.
Down, yep. Okay, now the great thing about expenses is that they are always debits. Unless there's an error or something like that. But for the most part, expenses are going to be debits. And if you go down here to this thing, you'll see, you know, if it's an expense, it's a debit. And this is good because as I'm sure you guys have figured out that if the debits have to equal the credits, if you have the debit, then it's really easy what the credits can be. You have whatever's on the other side. And those are always debits. So whenever you run into an expense, debit. Cash is an asset and it's going down. Now we know it's a credit because we know what the debit is, but if you come down here and take a look at it, you also see, you know, here's cash. It's going to decrease with the credit. But again, you know, if you say if you get one, if there's only two accounts and you know what, you know, one of them's a debit, we know what the other one's going to be. Okay, C, purchase supplies on account, 2,150. Which account?
Cash or supplies expense.
Well,
I'm sorry, supplies.
it'd probably just be supplies at first.
Yeah.
Wait, let me read this here. So purchase supplies on account. Oh, okay. So what kind of an account? What's going to be the account then? So purchase supplies.
Payable.
Yep. Yeah. So we haven't paid them yet. So we're going to have supplies and accounts payable. Supply is going up or down?
Up.
Up. Yep. This is the tricky one. Accounts payable going up or down?
Up.
Up.
Because it wasn't that tricky, yes. Very good. Yeah, so they're both going up. We got more supplies, but we owe more money now. So this will be okay. So supplies. It is an asset. And it's going up. So supplies asset going up with debits. Accounts payable, so liability, that's going to increase with credit. So supplies are the debit, accounts payable is the debit, and I get this thing from everything green. Okay, here we go. Supplies that's going up, and accounts payable. Oops. The liability, and it's also going up. We owe more now. We owe $2,150 more. Okay, D. Paid creditor on account, 1,100.
Accounts payable and cash.
Yes and yes. Accounts payable going up or down?
Up.
Close. Now this is going to be if we're paying them off. So do we still owe them as much?
Okay, yeah, down.
Yeah. So it'll be going down. Okay. How about cash? If we're paying-
Down too.
Yep. They're both going down. And you'll notice that our cash is an asset and account payable is a liability. So if they're on a balance sheet, assets equal to liabilities plus. So both sides are going down by the same amount. Okay. So let's take either one, I guess. But higher, but cash is decreasing, accounts receivable is decreasing. Okay. Let's. So cash. Oh, I could have left it. Cash is decreasing. Credit. Oops. Oh, there we go. Accounts payable is also decreasing and will be decreasing with the debit. So cash is going down with the credit. Accounts payable is going down with the debit. So accounts payable is the debit. Cash is the credit. Okay. So accounts payable. So liability's going down. We don't owe them as much anymore. $1,100. And we pay them with cash. Okay. Let's see. Okay. All right. E. Earned sales commission receiving cash. 18,750. All right. So what accounts are we going to use? The accounts from up here.
We're gonna use the cash and the sale commissions.
Yes, good, good. So cash and sales commissions. Now the sales commissions is really a revenue account. Anytime you see sales, it's the same thing as a revenue. But yeah, cash and the sales commissions, those two. Okay, let's see here. Sales commissions? Okay, so is the cash going up or down?
It's going up.
Up. And wait a minute. And the sales commissions, those are the same things as revenues. These are, put that on here. Kind of did a long, kind of did a long one. Revenues are always going up, and revenues are always. Here, there. Let's see, that would be sales. And sales are always going to be credits. Unless there's something wacky like an error or something like that. Revenues are going to be always going up. You know, 2 months worth of sales is going to be more than 1 month's worth of sales and so on. So as time goes on, sales are going to keep going up and up and up. So every month there'll be additional sales added on. You know, they'll keep increasing. And because they're always increasing, they're always credits. And actually you can kind of see that down here. They increase with a credit, but they're always increasing. Like I say, unless there's an error or something. Okay, so we have sales that's going up, and we have cash. Cash, asset, and it's going up. But again, we already knew that because if sales are credits, then whatever accounts on the other side has to be a debit. That's another, that's another thing about, well, I don't think journal entries are easy, the debits and credits, but if you get one side, usually you have the whole thing. So for instance, sales commissions. It's a revenue, and revenues are always credits. Well, if you know that, you really don't even have to look up the cash. I mean, you could, right? I mean, whatever's on the other side. So expenses are always debits, revenues are always credits. The nice thing is, so if you run into one of those accounts, you know what the other side is going to be. Now, there's a reason why it's it's an asset going up. But if you get one of them, you can get the other one. And this, I think I told you guys this way of writing the entry. This is really a condensed. Instead of writing a paragraph about what happened, it's just taking two accounts and putting them in. And it's, in a way, it's kind of foolproof. Not entirely, obviously, but because if you get, like I say, if you get one of them, if you know what one of them is, you know what the other one has to be. So if you know that, so while it's not, I would never say it's easy. It's it does have a few things in it. Okay, F, paid automobile. Paid automobile expenses, including rental charge. What, 1580. Miscellaneous expense 800 and pay. Oh, let me read this again. Okay, automobile expense was 1580 and miscellaneous expenses 800. You can combine the cash. Oh, I shouldn't have said that. I gave you one of the accounts. All right, well, let's what the accounts are. I already said cash. So what are the other two accounts going to be? So paid automobile expenses, 1580, and miscellaneous expenses, 800.
Rent and miscellaneous expense.
Yeah, it didn't occur to me. There actually is kind of a weird one because they say automobile expense in the problem, but you're right. It could be rent expense because it said including a rental charge. It probably doesn't matter too much. Expenses are expenses, but I think they want us to use automobile expense. But if you use rent expense, that's fine. And then miscellaneous expense. Okay. Now let's go down there. Hey, I spelled miscellaneous right. All right. Little steps. Okay, so, well, let's take the two that are going to be the easiest ones. Those are actually going to be the expenses. Expenses are always increasing. What's happening to our cash?
I think it's gonna go down.
Yep. Yeah, because we paid these, right? read it again. Paid, yeah, so they're paid, so the cash can go down. Okay, now, expenses. You see an expense, you say, hooray. Well, probably not out loud, but any expense, automobile expenses are on here, but any expense is a debit. So once you know the debits, you know what the credit is. However, we're not here to our cash. Cash is going down. Okay, so cash is going to be the credit. Expenses are always debits. I'm going to put this as two separate entries. You know, two separate lines here. Let's see what it is. Okay, let's do the automobile expense first. Again, yeah, if you put rent expenses, it probably wouldn't make too much difference. Automobile expenses, 1580. And the reason I say it won't make too much difference is that expenses are all going to show up on the income statement anyways. So it isn't like, oh, if I say rent expense, it's not going to show up. It is. Okay. Cash. Asset going down. And the miscellaneous. And you could combine the two cash accounts. I would probably put it in separately. That's just the accountant in me saying that. The book will probably show those, would show those being added together. They show 1580 plus this, and they have one entry here. And if you're wondering why I'm saying that I would probably put it in separately, is if you add those two together, it comes out to whatever it does, 2380. You add these two. And the problem is, if you look in the cash account, you're not going to, you know, if you're looking for this 1580 in the cash account, if you don't put these in separately, you're not going to find it. And so as an accountant, it's a good idea to put those in separately. It just makes it easier. Invariably, someone's going to ask you, well, you know, where's this expense? Where's the, where would we pay these people or whatever? And if you look in the cash account, you don't see it, you know, you're going to be digging through stuff, you know, trying to find out what happened. It's just easier. Okay. G, paid office salaries, 3,500. What accounts? So we paid office salaries, 35. This one here, $3,500.
Wage expense and cash.
Yep.
Oh,
They're probably going to call it office salaries expense. If you put wage expense, that's absolutely fine. But using their accounts up here, they probably use office salaries expense. Wage, again, wage expense is fine. You know, it's an expense. Okay, and cash. Okay, the office salaries expense is always increasing. Any expenses are always increasing. The cash account, is it increasing or decreasing?
Decreasing.
Yeah, it's going So we're paying these people. So paid, so this would be. Now, the nice thing about expenses. Expenses are debits. Cash, it's an asset going down with a credit. But again, like I say, if you get half of it, expenses, expenses are credit, are debits. So it's all there. So if you get half of it, you know what the other is. So this one would be, and again, you can use wages expense, that's fine. Cash is an asset that's going down. 3,500. And you already knew that though, because the expenses are always debit, so cash was good. Okay, H, determined that the cost of supplies used was 1,300. Okay, so we used up some of these supplies. We used up 1,300 of them. So the supplies were, where did we buy them? I don't know, up here somewhere. Okay, so these are the supplies. So these are the supplies. Now it says that we used them up, 1,300 of them. So we have to take some supplies out of this account, right? There's no longer 2,150. So if these supplies went up with a debit and we got to take 1,300 out, would the 1,300 be a debit or a credit? If we're reducing the account.
A credit?
Yes, good. And what other account are we going to use? So we have supplies. And what other account is related to supplies? It's a little bit tricky because cash isn't actually going out, the supplies are going out.
So the supplies expense?
Perfect. Yep. So that H. Okay, so we're going to use supplies. And supplies. Okay, and supplies are going.
Oh,
The expense is going to go up.
I'm sorry, the supply expense, yeah, is going up. Sorry.
No, that's fine. And so the supplies expense is always going to go up. And this is a little bit tricky in that it's actually not cash leaving the place. This isn't like rent expense because it's not, you're not bringing a check for cash, but the supplies, which are an asset like cash, are leaving. So you have less supplies now. Those are supplies that went out the door, maybe the expense. Expenses are always debits. $1,300. And truthfully, at this point, yeah, you know what the supplies are going to be a credit. But if you go down here, supplies are an asset. And it's going to decrease with the credit. So supplies are going down. We use up 1,300 of them. So they're going to decrease with the credit. Oops. Hi. Paid dividends. What accounts?
Retained earnings and dividends.
Close. The retained earnings, there's two ways to record dividends. One is through retained earnings or through the dividends. So the book uses dividends. I want to stay with using dividends. So the dividends are what we're going to use for the for going out. But it says that we paid these. So what other account are we going to use?
Cash.
Yep.
Cash.
Yep. But no, but there are, like I say, there's two ways of doing it. And quite honestly, I would run it through retained earnings, but the book doesn't do that. They have a dividend account. So, oh, wait a minute. Here first. So the dividend account, it's, according to the book, it's increasing. Cash, if we pay these out, is it going to increase or decrease?
Decrease.
Yep. So these are paying out cash to the owners. Okay, so cash is going credit. And way down here at the bottom, dividends will be a debit. So this is what we're going to always debit the dividends. We haven't talked about this, but dividends is a sort of contra account to equity. So their increase will be decreasing the total equity account. They say I would usually just run through right through retained earnings, but the book doesn't do that. Okay. There's no right or wrong way on that. It isn't like I'm right and they're wrong. It's just different people doing it different ways. Okay, I think I'm going to make an executive decision that we are not going to do PR 2-2B. I think we'll stop here as this one. What I would like us to start though is the practice exam. What time is it? 6:49. Okay, I tell you what, why don't we come back at, let's come back at, I don't know about this. We'll come back at 7 and we'll start on the practice exam. So let me. And I'm going to resend the stuff out again. I can tell by my email that some people haven't got it, so I'm going to send it again. And we will do the chapter 2 practicing. Okay. So we're gonna pull that up and I will be sending it out again. Blackboard, by the way, is can sometimes have actually it usually sends stuff out, but sometimes it delays it, and not by like a couple minutes, or sometimes it's been delayed for days. I shouldn't say days, but a day.
Still not good.
No, it isn't. But you send something out, and then it's kind of funny because I'll be sitting there, I'll have resent things out, and I think the longest it's been is 22 hours. But 22 hours later, my thing shows up. Okay, so let's see here. Practice exam. Okay, you should have gotten it. I'm going to go ahead and put it also into the files. Okay, so it should be getting your email. If you didn't get your email, it's in the course files in Blackboard also at the very bottom. Okay, so should have the practice exam. Anyone that does not have it, okay. A lot of these first ones here, they really kind of beat up the what they call the balance sheet equation. Yeah, oops. So they really kind of beat this whole thing up that, these two sides have to balance. So, those have to equal this. So that's kind of what they're, not all of them, some of them. Anyway, so number one, collection of a $600 accounts receivable. Well, what accounts are we going to use? You collected cash, right? So cash is going to be one of them. Is the cash going up or down?
Down.
Nope. Cash is going up.
It's going up.
Yeah. So plus 600. Okay. What other account though are we going to have?
Accounts receivable.
Good. Going up or down?
Down.
Yeah. Good. I'm going to abbreviate that one. Yeah. And by the way, you can feel free to abbreviate it on the test too. In fact, you might as well just call it AR. Okay, so cash goes up. The people that owed us the 600, they no longer owe it to us. That's what accounts receivable was someone owing us money. So they no longer owe it. Okay, so which one of these is going to be the answer?
The first one.
Increase in assets 600, decrease in it. Yeah, yep. Oh, I did this wrong. Okay. Yep. So it's going to increase the asset, cash, and it's going to decrease an asset, the accounts receivable. Copy that thing. Okay, an individual asset is increased then. Okay, so if an individual asset is increased, so we have an increase on the asset, whatever asset it is, they don't say, but it goes up. Okay, so what else has to happen? So, if we just increase the asset, it's not going to balance. So if the asset goes up, what would have to happen to the liabilities or at equity to make it balance?
They would decrease.
No increase.
Yeah, they both have to, or one of them would have to increase, or both of them together would increase. So, if this side goes up by some amount, I'll just put it in just an example of $10, whatever it is. If this is going to balance, then I got to learn how to use a computer. If this is going to balance, then it's going to be on this side. Something has to go up by $10, right? So if it's a liability or equity, it's going to have to increase. So it's not going to decrease in the liability. Decrease. Okay, there is another scenario though, and that's kind of like what we have up here. So if this doesn't happen, if you don't have an increase over here, what else could do it?
A decrease in the asset,
Yep. Very good. So which one is it?
the C.
Yep. Yeah. See, so if this one doesn't happen, okay, we don't get that one. You could. Oops. Also decrease the asset by the same amount, and it was still balanced, right? If the assets went up, it actually is like this one up here. I just used $10 instead of 600, but same thing idea though. Okay, let's do this. Purchased an asset on account.
It's B.
It is B. Yeah, our so we purchase our asset on account. So our assets are going to go up some amount. They don't say how much it is, but and then our liabilities, our accounts payable is going to go up, and they'll still be in balance, right? Plus on this side, but whatever amount it is. There's something weird in my spacing on this one. Okay, the payment of a liability. Well, what are we going to pay with?
With assets.
Yeah, so assets, cash probably.
Cash.
So cash is going to go down. Oops. Let's pick that up. And how about the liabilities?
It's gonna go down as well.
Yep, good. Yeah, we're paying off these liabilities, so we owe less. So which one is it?
D. The D.
Yeah, you're right. It's D. I should change this so it's not the same as what I'm doing for the other ones. Okay. Probably doesn't matter. See, I don't know why I did this wrong too. I did something with the formatting on this. You know, I always try to update my handouts and stuff and change stuff around, and then I should just leave it. All right, paid a dividend. Paid means what?
Cash.
Yeah, probably cash. Going up or down?
Down.
And
Yep, down. Okay, now this is where it gets a little bit tricky. The dividends will actually reduce the retained earnings. And the retained earnings go in which section? Yep. So the dividends will reduce the retained earnings. And retained earnings will be in the equity side. So which one is it?
is it A?
Yeah. It is A, right? Decrease assets. Yep. And yeah, it's that one. And by the way, on the test or whatever, if you want to put these things in, that's fine too. I can figure it. You know, don't worry about the spacing on it. I can figure out what's going on usually. Okay. By the way, that running around you hear upstairs is a little dog we got. A little dog from a rescue shelter that is just nuts. Anyway. According to purchase equipment for $1,800 cash. As a result of this event, okay, well, they purchased equipment for cash. So the two accounts they would use are what?
They're both assets.
Yeah. So it's going to be cash. Oops. All right. Okay, I'll do it down here. Cash and equipment. And yes, those are both assets. Cash going up or down?
Down.
No, good. Equipment going up or down?
Going up.
Up. All right. So, which one?
See?
Yep. Perfect. Okay. A debit to the asset account indicates an error. It could be.
It's an increase in the asset.
D.
Yeah, it's a decrease in asset.
Decrease.
So a debit. No, wait. No, it doesn't. Wait. I'm sorry.
Wait.
I said no, a debit to an asset account. Well, let's look at it. An asset account, a debit means
Increase.
increase. So now I forgot which one it was. Yeah. Someone said D. Yeah. D. Debits. Okay, this goes into assets and liabilities. Let's go down to let's go to the big kooky one here. Debits increase assets. I gotta change this. This is a picture. It inserts as a picture. I want to be able to highlight it and stuff. Okay, so anyway, enough of my problems. So for assets, a debit is an increase. For liabilities, debits is a decrease. Let's go back up. So debits do what? I should say which one.
C.
Yep. Perfect. You know what's not perfect is me. I got to do bold and underline first before I highlight. I keep forgetting that. Okay. This one we haven't talked about. So the normal balance of any account is we haven't talked about what normal balances are in accounts. I'm going to go all the way down to the end here. Okay. And the normal balance in an account is whatever side increases it is the normal balance. So for expenses, it's a debit. For assets, it's a debit. For revenues, it's a credit. Liabilities, it's a credit. And equity, it's a credit. And I kind of want to explain why a little bit. Debit, what they mean by the normal balance is what does the balance say at the end of the year in that account? Let's take assets, for example. If you have equipment, it's possible, so if you have some amount in equipment, it'll be a positive debit. It's possible you don't have any equipment, which should be a zero, but you can't have negative equipment, right? I mean, you could have zero equipment or, but you can't have negative. The same way, like say for cash, you could have zero cash, but you can't have negative cash. Same thing with these other accounts. Your accounts payable, if you have any accounts payable, it's going to be a credit. There's going to be something in that account. It's possible that you don't know anybody and you have zero in the account, but you're not going to have negative liabilities, right? So wherever the plus is, that's the normal balance in those accounts. Again, because, assets is probably the easiest one to think about. You can't have negative land. You could have zero land, but you can't have negative land. All right. So this one, oops, I made this smaller. Let me make it, whoa. Okay. So this one would be C. The side which increases the account. And again, that means at the end of the year, if there's anything in that account, it'll be whichever side increases it. And recorded any account transaction in a double entry system. Now, double entry, this means that there has to be at least two accounts. It's not going to balance if there isn't. So the question is, what does that mean?
See,
Yes. And so let's go through these. Now, ACE is the number of debit accounts is equal to the number of credit accounts. They don't always have to equal. Usually it's one to one. But if you recall, we had three accounts where two of them were assets and one was, whatever it was. So anyway, you can have odd numbers, but as long as the total amounts are the same, that's what they're talking about. That the total amounts of debits and credits have to be the same. Okay. When a company has performed a service but has not yet received payment for it,
Okay.
Yeah, yep. And if you actually look at it, if you think about performing a service, it's going to be a revenue. Revenues are always credits. So this is the only one it could possibly be. But yeah, it is A. It's the accounts receivable and credit service revenue. But if you know revenues are always credits, it's the only one it could be. Okay. We'll do the next one. Okay, company receives a utility bill, but will not pay it right away. It should.
B.
Yep. Yeah, expenses are always debits, so it could be A or B if you look at just the expenses. But if this is a bill, we're gonna have to pay it. A, I don't think we talked about. Did we talk about unearned revenue? I don't think we did. Unearned revenue is when someone pays us in advance. And unearned revenue is actually not a revenue, it's a liability. So we're going to debit cash. Our cash is going to go up.
Is it A?
Actually, this is kind of the other way around. This is when prepaid is when we pay something in advance. This is somebody has paid us in advance. So let me go down to the sheet here. Okay, so it's kind of like this. Oh, wait, hang on. These are on two different. Let me do something here. All right. If we pay in advance, it's prepaid. This is a little bit different in that this is somebody paying us in advance. So this is going to be unearned revenue. Now, unearned revenue really isn't a revenue, it's a liability. So when someone pays us in advance, our liability is going to go up, it's going to increase the credit. Now, truthfully, we always say that revenues are credits. So even if you get confused on the unearned revenue and say, oh, it's a revenue, the journal entry would be okay. But yeah, so this is what we're going to use when someone, this is somebody paying us in advance. We got money that we haven't earned yet. Oh, which is it? It's that one. And I did it again. Hold on. Why? Okay. So, and the reason this is a liability is if we don't do anything, if we don't do what we're supposed to do, we have to pay them their money back. So if they gave us whatever it is, $1,000 to do some service, if we don't do the service, then we have to give them the money back. So because of that, it's a liability. Now, eventually, the revenues will turn into hopefully when we actually complete the service. So whatever it is they want us to do, we complete the service, then it becomes a regular revenue. But until that time, it's a unearned revenue. It's a liability. We didn't talk about that. Okay. Let's go to the accounts. And it's just saying whether they increased or decreased and whether they're going to be a debit or credit. Now, you have to know what kind of account they are. To do that, and you can look on the sheet over here, obviously. And this is something you can use on a test too. So, okay, cash account increased. Will it be a debit or a credit?
Debit.
Yep, cash. It's an asset. Increase with debit. Revenue increased.
Debit again.
Nope.
Credit.
So revenues will always be credit. Now, the cash that you get will be the debit, but revenue itself. supplies account decreased.
Credit.
Yeah. It's an asset. Supplies is going down with credit. And by the way, once you get used to kind of going through these, you can see like for myself, assets was the one that clicked the first. Is that any asset that goes up is a debit, any asset that goes down is a credit. So, and you deal a lot with assets in that. So anyway, if you can get the revenues and expenses, the expenses are debits, revenues are credits, and then if you can get the assets down. Okay, accounts payable. The accounts payable account decreased by, so accounts payable went down.
Debit.
Yep, good. The liability, and it's going to decrease with a debit. Prepaid rent account increased by 1,200. What kind of account is prepaid rent? Could be an asset. So prepaid rent account, this is when we pay rent ahead of time. So prepaid rent account, if, oh, here it is, prepaid rent. If it increased, it'd be debit or credit. No one?
Debit.
Debit. Bonds payable account increased.
Credit.
Yep. Bonds payable is a, let's see my hand. Bonds payable is a liability, and it's going to increase with credit. Utility is expense.
Debit.
Expenses are always debits. Revenue, service revenue. Revenues are always
Credit.
credit. The equipment account decreased.
Credit.
Yep, good. Equipment is an asset, and it's going to go down with a credit. Unearned revenue account increased.
Credit.
Yep, unearned revenue, liability, increase. Advertising expense. Expenses.
Debit.
Yep. Okay. Journal entries, kind of like what we just did. I will usually, you don't have, but by the way, I put the two accounts on the other. You can jump right into the journal entries if you're feeling comfortable. But I like to put the accounts we're working with up on top here and then go in there. So purchase supplies with cash. So which accounts are we going to use?
Cash and supplies.
Yep. Let me choose. Cash going up or down?
Yeah.
Supplies.
Going up.
Yep. So what's the journal entry going to be? Looking here. And another.
Cash is the credit.
Yep.
And then the supplies is the debit.
Yep. And yeah. And again, this the journal entry thing. If you get one side of it, you actually you know what the other side is. So cash asset going down by 200. Borrowed cash from a bank using a note payable. What account?
Cash and accounts payable.
Cash, you can use accounts payable, it'd probably be notes payable,
No payable.
but either one, the payable is fine, because payable tells us that it's a liability.
What's the difference between an account and a note?
Not much. I mean, for us, a note payable is it's kind of like a check. It's almost like a post-dated check. The only difference is some notes payable will sometimes have interest attached to them, but it's sort of like saying a promise to pay somebody. It's a legal document that you must pay. If your name is written on it, you must pay it. So it's a little bit more, but it's similar to like a post-dated check. And it says, okay, I'll pay this at the end of March or whatever. And at the end of March, if your name is on that, you have to pay it, regardless of whatever else went on. So it's a little bit more formal of an agreement than accounts payable, but it's similar to a check. Okay, so is our cash going up or down?
Up,
Up. And the tricky one, notes payable.
up.
Oh, I guess it's not that tricky. Yes, you're right. They're both going up. We owe more people now, right? The notes payable. Okay, so what's the journal entry going to be?
Cash is the debit, notes payable is the credit.
Yes and yes. So cash is going up with a debit. So they got $8,000 more cash to work with, but they owe $8,000 more. So the liability, the accounts payable, it's going up with the credit. Received utilities bill.
Utility expense and accounts payable.
Yes and yes. Perfect. So utilities expense. The accounts payable at night, and you'll notice that it says received it. It doesn't say that we paid it.
Right.
So utility expenses are always going up. The accounts payable going tricky one, going up or down.
It's going up.
Up.
Yep, good. Expenses are always debits. Yeah, they're always debits unless there's an error. Okay, and accounts payable is going up. If you look under liabilities, accounts payable is going to increase with credit. Owe employees for 1 week of wages. What accounts?
Wage expense.
Yep.
And cash,
Not yet.
Accounts payable.
accounts payable,
Payable.
It's sneeze payable. I'm sorry. It's yeah, some kind of a payable could be accounts payable. Probably wages payable. Probably,
Wages payable.
but yeah, it's some kind of a payable. If you put accounts payable, it's fine. The important thing there is that it's a payable. That it's we owe somebody. Okay. Expenses are always going up. Wages payable going up or down?
up,
Up. We owe more. Okay. Nice thing about expenses are always
debits,
and wages payable is going to be a liability. Right out here, but any other payable liability go up to credit. All right, use cash to purchase equipment.
cash and equipment,
Yep. Cash going up or down?
down,
Equipment.
Going up.
Up.
What's the journal entry?
cash is a credit, equipment is a debit,
So cash is going down. If you look on your and by the way, I put this asset going down. You don't have to put these in here. Yeah, no, these things here. I put that in so you kind of know where I got the debit or credit from. Equipment. An asset going up. Paid cash for a truck. What accounts?
cash and automobile expense,
Close. Eventually, we'll have an expense on it, but probably not initially. So cash is right. And it'd probably be equipment, but it also could be truck. Now here, and I'm not going to go into this until next chapter, but it will get expensed eventually. So what would happen is, this truck is probably going to last for more than a year. So what they'll do is, for instance, let's say it's going to last for 5 years. What you would do is you would expense, take 4,000 divided by 5 years, whatever that comes out to, and you'd expense that much over each year. So we do expense the truck eventually, but we do it by probably how many years we have it is a common way of doing it. So it's going to depreciate. It's going to go down in value a little bit every year. So you're absolutely right that it is going to get expensed. It's just going to be expensed over a longer period of time. Okay, cash going up or down?
Down.
Okay. And by the way, you can also use the instead of equipment, if you put this in as an asset called a truck, that's fine too. Now, some companies will put, equipment they'll put it's a truck or the drill press or whatever it is. Okay, equipment. Oh, equipment going up or down?
up,
What's the journal entry?
Cash is a credit and equipment is a debit.
Supplies are purchased on account. What are the accounts we're going to use?
Supplies and account payable.
Yep. The supplies going up or down.
Going up.
The accounts payable.
Up.
Good. That's one of the tricks most people. The accounts payable. Okay, so supplies are going up. So what would the journal entry be?
Supplies debits, account payable credit.
Supplies is an asset. Yep. 690. And accounts payable, if you look on the sheet here, accounts payable is a liability, credit. Oops. Yeah, so one thing, if you're wondering why, debits and credits and some people, you get, it's confusing about the credit. When someone says they're going to credit your account, that just means that they owe you more. They're telling it from their point of view. So from their point of view, they owe you more money. From your point of view, it's a debit. They don't care about your point of view. So they say we're crediting your account. That means you should be debiting your account. So, okay. Perform services for cash. What accounts?
Is it cash and service revenue?
Yep. Cash going up or down?
Up.
And service revenue always goes up. Oops. Yeah, that's right. Okay. So what's the journal entry going to be?
Cash debit, service revenue credit.
Yep. Cash. So keep going up. And service revenue. And the nice thing about revenues is that they are always,
Going up.
they're always going up and they're always credits. So whenever you run into a revenue, you say yippee, because it's always going to be a credit, and whatever's going to be on the other side is going to be a debit. Purchased office equipment on credit. Now, when they say on credit here, they mean on account, basically. So they purchased office equipment on account. So what are the accounts going to be?
Equipment and account payable.
Yep. Yep. Perfect. Equipment going up or down?
Going up.
And accounts payable?
Up.
Good. Journal entry.
Equipment debit, accounts payable credit.
Yep. Equipment's asset going up. The accounts payable is also going up. All more people now. No, it's not an asset. It's a liability. Purchase land for 25. Equipment and land for $25,000 cash. Okay, I'm going to insert a row here. How do I do that? Okay, here we insert. Okay, now I really goofed it up. Okay, I would probably break this up into two different entries. You could put it into one entry. Okay, purchase equipment. Okay, so the accounts we're going to use are
Equipment, land, and cash.
equipment going up or down.
Up,
Land going up or down.
up,
Cash going up or down.
down.
So what would the journal entry be?
Equipment debit for 10,000, land 15,000 as a debit, and 25,000 for cash as a credit.
Asset going up. And you could split that cash up. You know, if you wanted to do each of those separately, you could. You could put equipment 10,000, cash 10,000, land 15,000, cash 15,000. And the reason why you may want to do that is more of a, if you're an accounting person, because if someone asks you, well, where's this purchase? You know, we purchased land for 15,000. Where's that in the cash? You're not going to find it. You know, you have to go back and figure out, oh, it's, you know, it's both those two together. And by the way, if you're wondering, well, why do we do this? Why do we care, you know, land and equipment? Why do we care how much goes to each one? It has to do with that depreciation thing. Like equipment usually doesn't last forever, so it can last for 5 years or 10 years or whatever. Land, we assume lasts forever. You know, the land under a building, you know, eventually the building will get torn down and put up another one. But the land underneath it stays around forever. So we don't depreciate land. So land does not go down in value, whereas equipment does. So that's why we kind of make sure we break them up there like that. Okay, received cash from a customer previously billed. This is a tricky one.
Cash.
Cash.
Accounts receivable.
Good. It's not that tricky. Not enough for you. All right, cash going up or down?
Up.
Up. Accounts receivable? Up or down?
It's going down.
Good. They no longer owe us for this 470, right? So we had on the books that they owed us 470. Well, now they just paid it. Now, don't get me wrong. We'd rather have the cash than, you know, we'd rather have the cash in our hands. So it was actually a good thing. But they no longer owe it to us. So. Oh, I should have had you guys tell me what to do with this. Okay, yeah, so cash is going up, but he no longer owes for the 470. So common stock to an investor for 10,000. What account?
Common stock and cash.
Yep. And let's take the easy ones. Cash going up or down?
Up.
Up. Common stock going up or down?
Up.
Good. We have more owners now. So what's the journal entry going to be?
Cash as a debit, common stock as a credit.
Yep. Yeah, our cash is going up. Our debit. And then down here, the common stock is going to increase with a credit. So, yep. So the cash is going up. And our common stock is also going up. And now we have more owners. Oh, tricky one here. Received a cash advance from a customer. What accounts?
Is it cash and accounts payable?
Close.
Cash and unearned revenue.
Yeah, but now but like a payable, it is, it's something you will have to pay back if you don't do it. And that's why we have it as an unearned revenue. It is a liability. Okay, cash going up or down?
Up.
Yep. And unearned revenue?
Up.
Yep. Yeah. So what's the journal entry going to be?
Cash with a debit and unearned revenue with a credit.
Cash is going up with a debit. And unearned revenue. Oops. Is a liability. It's also, we owe these people, basically we owe these people $360 until we do the work we're supposed to do for them. If we don't do the work, we got to give our money back. Okay, 38. We had one just like this. What accounts are we going to use? Well, issue just means sold.
Cash and common stock.
Yep. Cash going up or down?
Up.
Up. Common stock?
Up.
Up. Journal entry.
Common stock is a credit. Cash is a debit.
Yep. Cash. Okay, yeah. This one's hard. Billed to customer for services delivered. What accounts are we going to use?
Accounts receivable and service revenue.
Yeah.
Yes and yes.
Mm.
Revenues are always going up. Accounts receivable going up or down?
It's going up.
Okay, so what's the journal entry going to be?
So accounts receivable will be debit and service revenue will be credit.
Perfect, perfect. Okay. So accounts receivable is an asset going up. And service revenue as the magic word revenue. Okay, it's not really magic, but they're always credits. And that's it, right? Okay. Okay, so what I'm going to do is I'll put in a. Let me write it down. Oh no, I ran, I ran out of notebook paper. All right. Well, we'll have to improvise. All right. Screen here. Okay, so the assignments will be. We did problem 2-2A. So that'll be one. The practice exam. We just did chapter 2. And then third, I'll send out the exam for chapter 2. I'll send this out by about 10 o'clock tonight, and you'll have a week to turn it in. So I'll put those, so these two will be put on in Blackboard as an assignment. This will be put on as the exam. Again, this will be due a week from today. What is today? 16th, so 23rd. And so I'll give you a week to turn it. So these two we already have done. We just did those. And then this I'll be sending out by like 10 p.m. tonight. I should get it out. I actually I haven't made it up. I just want to check them over, make sure make sure there's nothing glaringly wrong with them before I send them out. Any questions on that? Okay, well, there's the camera. Hello. So any questions on it? So I'll send out the exam about 10 o'clock tonight, or by 10 o'clock, I should say. And that'll be doing a week. I'll put a place to submit the problem 2-2A and the practice exam for chapter 2. And you don't have to do problem 2-2B. I think it's on that answer sheet. You don't need to do that. So those will be the ones you submit, and then the chapter 2 exam, which I'll be sending out shortly. Any questions?
I have a question.
Sure.
So the only thing that's due today is the part 1 and part 2 that we did last week?
Part 1 and part 2 are due, yeah, from last week are due. And again, they're due, even if they're past due, you can still turn them in for full credit. It's just that's when the grades go on. That's when it goes into your grade to date. so you can always turn them in, and I encourage you to. You get 100% credit for it, so you can always turn them in. But yeah, I believe you're right. I think for this week, the one that's our due are the part 1 and part 2. Chapter 2 handout part 1, chapter 2 handout part 2. And again, those are the same ones that we did together on the Zoom meetings. And if you weren't there for the Zoom meeting, they're recorded, so you can click on them and just it'll kind of walk you through, and you can fast forward them if you want. But yeah, so any questions on any of that?
Okay, thank you.
Yeah, and after the due date, your grade will go in as a 0. That can be changed. So if you submit it, I'll go back in and make the change. Okay. All right. Well, I'm going to go ahead and I'll send you out the chapter 2 exam. And I may send out a follow-up question just to make sure everyone got it. So if you get expect after that I'll send out another email saying, did you get the chapter 2 exam? And let me know if you did, maybe more importantly. Any questions on that? Okay. All right, guys. Well, I will talk to you next week. I also have office hours on Friday at some time I forgot. I think it's the wait, I got it. Oh, office hours. Okay. There are tutors available. Friday noon to 1 plus, so if you move longer. And then Friday at noon and at 6 p.m. I have Zoom meetings if you guys want to attend those. Or if those times don't work for you, get a hold of me and we can set up another time. I don't think that those are the only times that that I'm available. I'll set up other times. And then there's tutoring available too. So there's also a tutoring tab in Blackboard that you can see that has some of the tutors that are available and what times they're available at. Okay, well, if I don't see you on Friday, then I'll see you guys in a week. And I'll send out the exam will be sent out by 10 o'clock, let's see. Any questions? Okay, and then this video will be posted probably around midnight. It takes about an hour to render from the Zoom meeting, and then I edit it. Takes about another hour to render, and then it goes into YouTube. And YouTube's kind of strange. Sometimes it'll take 10 minutes for it to process, and sometimes it takes 2 hours. So, but anyway, by midnight it should be up. Questions? Okay, guys. Well, enjoy the rest of your evening. Hopefully you don't need to dig a car out or anything. All the snow we're having, but I will talk to you guys next week or Friday.
All right. Thank you, Professor.
All right, good night, guys.